on, everybody? Thank you so much for checking in. My name is Q, and today I'm going to talk to you a little bit about what it means to buy the dip and how to take advantage of a market correction if that was to happen anytime soon in order to add to your long-term portfolio. So, first of all, you want to choose the long-term stocks that you want to buy. So, if you're looking to buy Apple, if you're looking to buy Microsoft, pull up the chart and apply the method that I'm going to teach you. That way you can take advantage of any type of market decline or crash to add to your position. First things first, in order to buy the dip, you need to have capital on hand. So if you are the type that's looking at Apple right now and you're thinking of going long term, and the stock is trading at $154, which is right at its all-time high, then you may want to reconsider adding to your position until we get a nice market pullback or a market correction. Considering most stocks at their all-time highs right now, it is not the best time to add to a long-term portfolio, in my humble opinion. You want to wait for a significant pullback to take place for you to begin adding to your long-term portfolio. So, what do professionals use, and what indicators do they look at in order to add to their long-term portfolio? I'm going to go and show you the different indicators that they focus on, and most of you already know this. The first indicator is going to be the 10-day moving average, second is the 20, third is the 50, and last is the 100. Now, for the sake of this video, I'm going to remove the 10-day moving average and I'm going to make it the 200-day moving average. Okay, so the reason why I did so is because you're looking for a strong enough to pull back to justify an entry for a long-term portfolio investment. So you don't want to really add the 10-day moving average. In order to go any further, I think I need to explain to you what moving averages do in case you do not know. Moving averages pretty much take the average price of the stock over the given amount of time that you give to the moving average, and it averages it out over that period. So for example, if this is the 20-day moving average and it's trading at $150.78 currently, we can see them from these numbers here. That means that for the last 20 days, the average price of Apple was $150.78. So when we know this, we know that Apple will eventually try to revisit that price naturally. So ask yourself, is it really worth buying here at this pullback, or should I wait for a longer pullback? So the next moving average you can look at to start adding is going to be the 50-day moving average, and the one after would be the 100, and the one after is going to be the 200-day moving average. Now, naturally and normally, the highest moving average that traders really focus on is going to be the 200-day moving average. So that's where you're going to see a lot of buying take place. Let me give you an example. So every time that the stock has pulled back in the last, I would say, few years, the stock would come down below the 50-day moving average, or I'm sorry, the 200-day moving average, which is the yellow line here. But notice how it doesn't stay below for too long. Notice how the stock will only come down below it for so long before it begins to move back up, comes down below it for so long. See, this is only 2 months and begins to come back up. Now, this is natural when you are in a strong enough or good enough stock. This is Apple we're talking about. Some stocks do not survive these declines and they stay forever below this moving average. So you need to understand the fundamentals of your company too. There are plenty of names out there, and they're going to be the FANG stocks, the Facebook, Amazon, Apple, Netflix, and Google, in which are going to be very strong fundamentally. So anytime these stocks move down to their 200-day moving average, you will naturally see people buying them up. And you can see that happening here. You can see that happening here. You can see that Apple right now is straying a little too far from that 200-day moving average. Therefore, we can expect it to come back down. Now, what are there are pros and cons to everything. So the pros is we know to add these moving averages. The cons is that if Apple was to have a random spike up and it moves from 150 to 200, now that 200-day moving average is going to average up mathematically. It's going to move up and it's going to be probably above 140 because the average over the 200-day days that have passed is obviously going to be a lot higher. So it's always good to do the following. It's always good to use these as guidance to start adding positions. So incrementally add positions. Don't go full blown out and buy all the portfolio and all the cash you have, put it in the stock um, right at the same moving average. So if it hits that 50-day moving average, take advantage of that, add a little bit. If it hits the 100-day moving average, take advantage of that, add a little bit more. And if it hits the 200-day or breaks below it, and if you really love the company, buy as much as you can, because that is an opportunity in which doesn't come up often. Now, when it comes to, I'm going to show you an example of a stock that's trading below its that moving average for now, and that's going to be Baba. That's one. So if you look at its 5 years, you can see that it's way below that 200-day moving average, and you can see that buying has significantly picked up within that period of time. Now, here's another stock, which is Pinterest. So Pinterest is now nearing. Pinterest hasn't been on the public market for long enough to create a 200-day moving average, but notice that it's trading below its 50-day moving average now, also creating a buying opportunity if you really like what the stock is doing. So there's going to be plenty of opportunity like this. You don't have to wait for a market crash to take advantage of this. Like I just showed you, Baba is just one stock. You also have Boeing. Boeing is another stock that's trading way below its 200-day moving average. And we know that this stock has some weight in the overall market, and you know that they have a strong future and they're backed very well. So there are plenty of companies in which you can find that are below the 200-day moving average, but make sure you review their financials carefully before you decide to take them on. This video, I'm going to go ahead and explain to you how this also works on cryptocurrency. So if we look at Ethereum, for example, and we pull up its correction period. So when Ethereum took off, it really strayed far away from that 200-day moving average. And notice when it came down to it, this is the daily candles, I'm sorry. When it came down to it, notice that it reversed right around that 200-day moving average, which was a key signal for you to buy. Most recently, just this week, Ethereum came all the way down to the 50-day moving average. Notice how fast it recovered back up because of all the buy orders that were already placed at that 50-day moving average. So when it comes to adding to long-term positions, find something that you love to invest in, a stock, a crypto coin, and look for those moving averages when there is blood on the streets, or the saying goes, when there is red, look for those moving averages to begin adding incrementally. And if it gives you the opportunity to add it at a longer moving average, the longer the better. Thank you so much for checking in. I hope